Let's take another look at this commodity sell-off. Our guest here is Reid I'Anson, economist at Kpler. Reid, great to see you again. Thanks very much for joining us.
Always good to be here.
Give us your broad thoughts. This does not look like good news for the commodity sector in the sense that it could slow global growth, this tariff war.
Yeah, of course, we saw very aggressive Trump tariffs announced yesterday, and we are scaling down our expectations for demand across a number of key commodities. Obviously, the United States being the leading driver of that, but of course, weakness likely in Europe, and also major questions within China as well. And so I think when we look at the sell-off in prices today, it's very much a reflection of concerns on the demand side of the picture.
Before we get into China, talk to us a bit about the outlook for the U.S. I mean, this could be a threat to the American economy.
Absolutely. We came into this year pretty optimistic, assuming 2.5% growth. We revised that down a bit in March to 2%, still believing that the Trump administration would pursue a pretty limited policy of tariffs. But of course, that has all shifted now after the announcement yesterday. So we have revised lower U.S. growth to just 0.8% and have risen our expectation or probability of a recession to 50%, up from 20% early last month. So again, real negative implications for the U.S. economy following the tariff announcement yesterday.
I suppose we have to be careful looking at the metals market because so much metal was apparently brought into the U.S. to avoid tariffs, and now it's not going to face duties anyway in the short term.
Yeah, it looks like some questions around Section 232 exemptions. You know, will these come into effect or not? Obviously, we saw a big surge in, say, copper purchases over the last couple of months trying to get ahead of tariffs. It seems like that price surge might be done now. And obviously, we've seen copper prices really come off quite a bit. I think that we could possibly see further weakness from here, just given concerns around global growth expectations. And also, a lot of that pre-tariff buying is probably about finished now.
Talk to us about China. You say they still have this problem of overinvestment and underconsumption?
Yeah, China, continues to face this problem of economic imbalance. They're relying too heavily on investment, too little on domestic consumption. And this means a very large trade surplus because they are outproducing their domestic consumption base by quite a large factor. And of course, this drives exports and the trade surplus to ever new highs. This means that China is particularly vulnerable to tariff implementation. We do think, though, of course, China has set a 5% growth target this year. They will push hard to try and meet that target, even if it means pushing a lot of fiscal stimulus into uneconomic investment projects. However, I think the long-term sustainability of the Chinese economy really requires that they find ways to start boosting consumption within the Chinese economy rather than investment.
And of course, I mean, this is so interesting, isn't it? China, in theory, facing duties of more than 60% on stuff it sends to America.
Yeah, I mean, it's a real question. And keep in mind, the United States accounts for 25% of global demand, right? So, let's just assume China stops exporting to the United States. That's still a real squeeze on Chinese exporters now that are now trying to push goods to the other 75% of demand, right? So you're likely to see a margin compression for Chinese exporters in the coming months, given this tariff implementation. And of course, the United States is not the only country implementing import tariffs on Chinese goods. Places like Europe and Canada, Mexico, Brazil, India are all implementing import tariffs. So this export-led growth model that China's really relied upon is likely going to come under pressure at some point.
Does it seem like, so I mean, that would seem to rule out, we had that boom in commodities in the first decade of the century driven by China. That's not happening again anytime soon.
Yeah, this has been key when I speak to clients, really level setting here, that the 2010s will not look like the 2020s. The 2020s will not look like the 2010s. We really don't have a replacement for that Chinese demand driver that we saw last decade, right? Places like India will certainly be core commodity drivers, but that investment-heavy led economic growth that we saw out of China is just, we really don't have a replacement for that this decade.
What about gold? Or would you be interested in gold right now as a flight to safety trade, for example?
Yeah, I mean, gold has just been on a tear over the last several months, and I think that it continues to make a lot of sense here. Yeah, it's a safety trade, but also gives you some diversification away from the dollar. So we've seen a number of central banks buying a lot of gold just to try and get some diversification that is not in USD. I think this is going to continue, especially with the Trump administration pursuing aggressive tariff policy. Also, you do have questions around the geopolitical environment. So again, I think all of this is positive for gold prices for now.
Let's have another quick look at gold, maybe a 10-year look. And interesting, you probably saw today the US dollar down, sharply down. Well, it was down about 2% initially. It may have come up a little bit. There's gold. But if the US dollar goes on weakening, in theory, that's great for gold prices.
Yeah, absolutely. And it's interesting, right? In early Feb, we saw the dollar strengthen on potential tariff implementation, and that tends to be what you see when a country implements tariffs. You tend to see a stronger domestic currency. We're not seeing this this time around. And this is being driven by the fact that interest rates in the United States right now are dropping. So those interest rate differentials are narrowing, and the US dollar is weakening as a result. This is also a reflection of weakening growth prospects for the United States. So yeah, a weakening dollar, definitely supportive of gold here.
Thank you very much, Reid. Great hearing from you. Reid I'Anson, economist at Kpler.